In this video, I'll be revealing how much you need to save to stay retired. Because whether you're retiring this year, in 5 years, or 10 years from now, making the decision to retire is one thing. But staying retired for another 20 or 30 years is another challenge entirely. I've worked with hundreds of clients who've successfully maintained their retirement lifestyle across decades, and I've seen what happens when people don't account for the blind spots that can completely derail retirement plan. So today, I'm breaking down the actual numbers you need to stay retired comfortably and how to plan for the increasing cost and potential blind spots that may challenge your retirement. Let's get right on into it. If you want to retire this year, you're likely already weighing the pros and cons of that transition. But before you make a decision, you need to be confident that you can actually stay retired once you decide on pulling that retirement ripcord. The good news is your baseline requirements can be calculated based on something that you actually control, which is your lifestyle and your spending. Having a frugal or luxurious lifestyle isn't necessarily the question, but your lifestyle needs to match up to the assets that you've saved and the income that you'll receive in retirement. And for today's video, I want to talk about the average mass affluent retiree. They live off somewhere between $65,000 and $85,000 per year from their investments, plus Social Security. Now, obviously, some spend less and some spend more, but this is pretty typical for mass affluent investors with somewhere in the range of $1 million to $5 million in investable assets. That amount typically will cover their healthcare, housing, and discretionary spending, especially when you add Social Security on top of it. Now, using the 4% rule, you can get a ballpark of the balances that you'll need to safely withdraw to maintain that $65,000 to $85,000 per year without depleting your portfolio. When you do the math, you'll need somewhere between $1.6 and $2.1 million to support this level of spending for the next 20 to 30 years of retirement. The 4% rule was created in 1994 by William Benjamin after he did a deep dive on decades of financial history. And what he discovered was that the 60-40 portfolio of stocks and bonds could support an annual withdrawal rate of 4% for at least 30 years. However, the 4% rule is rapidly becoming outdated. Here's why. There's more efficient withdrawal strategies that have been created, and I'll tell you about the one that we like to use with our clients here in just a few minutes. But before I get into that, these figures that we talked about of that spending between $65,000 and $85,000 are based on what retirees that we work with typically actually spend, but you need to account for inflation in your retirement planning because if you don't, you might be in for a financial surprise, and trust me, it's not a good one. Now, of course, inflation is not linear, but having just an average inflation rate of 3% can impact your annual retirement spending needs, and it can do so in a pretty impactful way. Looking at just the next 5 years, if you're going to retire 5 years from now, keeping that same 3% inflation rate and wanting to spend $65,000 to $85,000 in today's dollars, that gets pushed up to between $75,000 and $100,000 if you were to retire by 2030. So if you want to retire 5 years from now, your purchasing power automatically gets reduced by about 16% if you don't plan accordingly for it. And to no surprise, this affects everything. Cost of food, gas, travel, all the vacations you want to do, what your housing expenditures may look like, and especially healthcare, which inflates at a rate closer to around 6.5% per year on average. And of course, any fixed income sources that you'll be expecting, like pensions, those might lose their purchasing power over the next 5 years, especially if they don't have a cost of living adjustment that's built into it. For example, that $1,500 per month that you're supposed to get from your pension now would have gone a lot further 5 years ago, back in 2020. But 5 years from now in 2030, it won't feel like as much in comparison. And of course, Social Security is supposed to get an annual cost of living adjustment, but for many people, it rarely feels like it keeps up with the actual inflation for most retirees. So if you don't want that to be you, here's the critical equation that you have to understand. Your portfolio growth should be greater than inflation plus withdrawals. Otherwise, you may run out of money before you die. But what if you're planning to retire 10 years from now? How much will you need then? In that same example, if we had a 3% average inflation rate, your annual withdrawal amount goes from $65,000 to $85,000. That window all of a sudden now turns into $87,000 to $115,000. And that adds a $700,000 to $800,000 increase of how large of a portfolio you'll need to have to sustain that level of spending throughout your retirement. So instead of saving 1.6 million, you'll need about 2.3 million once you factor in inflation into your projections. See, most retirement planning focuses too much on reaching retirement when it should be just as focused on how to sustain that retirement for decades. Using more detailed projections, including inflation, healthcare cost, and real numbers on everyday expenses, will help you understand if your current savings trajectory will be enough in the future. And getting clear on these long-term costs lets you make small adjustments during your working years that could prevent you from managing a crisis later on in retirement. For many people, it's easier to live a little differently today while you're working than it is to make a huge change to your life when you're well into retirement into your 70s. And understanding these trends will help you make the right choice for withdrawal rates in retirement and also understand how your portfolio should be allocated both now and when you plan on spending it in the future. For a lot of people, accumulation was the easy part, but they get hung up on how to properly execute the withdrawal methods that actually allow them to stay retired without having to worry about whether or not it'll be enough. Because at the end of the day, your retirement plan is more than just investments. It's taxes, it's health insurance, it's estate planning, it's withdrawal rates, it's when to take Social Security. It's how to put all of these pieces together in a cohesive picture that give you the confidence not just to retire, but to stay retired. So now that you understand the long-term cost projections, if you're ready to optimize your retirement plan and build your dream retirement, click the link below to book a call with me, and I'd be happy to walk you through it. So we talked about the 4% rule earlier, and look, it's fine for some back-of-the-napkin math, but it's rarely the best strategy you can use to execute on your retirement plan. Let me explain. Plenty of recent studies have shown that a flexible withdrawal strategy called the dynamic guardrails method can actually provide better outcomes. Here's how it works. Using the previous year's market returns, you adjust your current year's withdrawal rate in response. This usually operates on a range from, call it 4.5% to 5.5%, and helps you enjoy the up years more and also remain cautious when the market is down. For many people, especially when they just jump off the retirement cliff, it can help them insulate themselves from sequence of return risk, which means that bad years early on won't hurt your portfolio's chance of making it and sustaining it for the rest of your retirement. And a lot of times, this coordination with market cycles can help your portfolio grow effectively, beat inflation consistently, because ultimately, inflation is going to be your number one risk as a retiree, which is exactly why we use the guardrails approach with a lot of our clients. Because maintaining your portfolio's growth over the next 10 years is crucial to beating inflation for the next 2 decades and beyond. But just using the right percentage and paying attention to market cycles isn't the full story. Because for a lot of people, they might be leaving thousands of dollars on the table by using the wrong sequence of withdrawals. In fact, this often proves just as important as the portfolio size itself. You want to pull money from the right place to lower your taxes, not just today, but also in the future. Your portfolio is hopefully going to continue to grow, and you want to compound interest happening inside the right accounts with the best tax treatment possible. For a lot of people, what this really means is, how do I limit my lifetime tax liability? Saving was one thing, and keeping as much of what I've saved so far, well, that's also the goal. Now, in general, you'll want to pull from your taxable brokerage and pre-tax accounts like your IRAs and your 401ks first. Now, this can vary, of course, but high level, the reason we want to do this is because it'll allow you to knock out these more tax-heavy account types early on before they grow even larger, which will only compound your tax burden years from now. Also, in your taxable brokerage account, you can strategically tax loss or tax gain harvest inside of there. Managing your withdrawals can help you manage your income, and that becomes absolutely crucial and all the more important for the cost of healthcare and also, of course, taxes. In many cases, you'll want to save any Roth or tax-free money for last to give it as much time as possible to grow and compound. Using the sequencing order is often the difference between retiring once and staying retired, and it can save you quite a few $1,000s in taxes and huge chunks of growth in your portfolio if done correctly. In today's dollars, that $65,000 to $85,000 target that we talked about might have to be $78,000 to $102,000 thanks to a lack of tax planning, and that's before you even factor in inflation. Because here's the deal, having the right proactive tax plan can save retirees several $100,000s throughout retirement if it's done correctly. But most retirees find themselves stuck in no man's land. And I hear it all the time. My financial advisor says they can only help me with my investments, so I go over here to talk to my CPA. But when I go to my CPA, they're laser focused on reducing taxes for this year. They don't give me any clarity on how to reduce my taxes over the lifetime of retirement, hence being stuck in no man's land. And that is exactly where comprehensive financial planners specialized in retirement and tax planning can really help you fill a gap for clients with these advanced tax strategies that can pay off not just for this year, but for decades to come. For example, executing Roth conversions during your early years of retirement when you're living off of your taxable money and your income is low can become crucial for easing the tax burden of all of the pre-tax or 401k money that you've accumulated over these years. And these early retirement years are oftentimes a golden opportunity to make those conversions. There's another strategy that I like to call geographic arbitrage. It involves moving from a high cost of living area with high taxes to a much lower one in retirement. Of course, this only works if it's desired, but it can be a powerful tool if used correctly. One great example of this is there's plenty of New Yorkers that find themselves moving to Florida in retirement. They see an immediate 10% or more drop in state and property taxes and generally experience a 10 to 15% lower cost of living, of course, depending on where they settle in Florida. Now, assuming that changing where you live matches with your personal goals in retirement, you might find yourself with an automatic 20 to 30% boost in purchasing power, which obviously is absolutely massive. In addition to that, tax loss harvesting is another great opportunity to be able to utilize within the stocks and ETFs in your taxable brokerage accounts. Now, when you do this, you're recognizing your losses to offset your gains, and it could be a great play while you spend through this taxable bucket. Because effectively managing your modified adjusted gross income at this stage can help you offset the cost of healthcare by receiving credits for marketplace insurance, or of course, once you cross the threshold, not jumping into higher IRMAA brackets later on. But this brings up an even more important strategy, which is asset location. You should have some stocks in your taxable account along with cash. For example, I call that your conversion dry powder, or if you're going to do a bucket strategy, living off some of that cash. But you don't want to get hit with the higher yields of bonds payable as ordinary income inside of these taxable accounts when you can shelter that in your pre-tax IRAs that's going to be stuck with an ordinary income payment anyway. Conversely, your growth stock should be inside your Roth IRA for maximum compounding. What you think is going to grow the most, put that into your Roth. Because when you're failing to reduce taxes along the way, you're essentially only continuing to kick that tax can down the road. Because for many people, having all their money, or at least a strong majority of their money, in their pre-tax accounts that continuously compound while they're spending down their Roth first, well, it sets them up for a lot more RMDs in the future. And while for some people, that may not be a problem, for others, it's a big one. In your 70s and 80s, these will likely push you into higher withdrawals well beyond what you're actually needing to spend. And for many people, this is going to subject them to higher tax brackets, whether they like it or not. In fact, many retirees in this age band who don't prepare well and are used to paying in the 22% tax bracket suddenly find themselves jumping up into the 32% tax bracket instead. Even worse, if you're married and you didn't address this, then the surviving spouse, who now unfortunately has to file as a single taxpayer should something happen to you, well, that can make this compound even more. Because if you're in this situation, you already understand this. When you get to this stage of retirement planning, it's just as much about what you keep versus what you make. That's why having the right tax optimization strategy can provide much more stable retirement income than just building up a larger portfolio. Ultimately, you want your portfolio to be tax dynamic, have low tax drag, and be tax efficient. You need to set an anchor level of where you want your spending to be. We call this the lowest acceptable spend in retirement, and it's the amount of spending that you would need to feel reasonably confident about being able to spend, or else you wouldn't retire. That creates a target for your retirement spending that you can stress test with parameters for cutting back to essential spending during poor markets, or increasing to max or aspirational spending if the market does well. But in order to set these spending levels properly, you need to really be honest about what you can actually live on in retirement, or the things you would truly want to achieve with your retirement years. You're not doing yourself any favors if you could live on less money just to get out of working early. It has to be an amount that you could realistically be happy with and live comfortably on for years to come. And often what we find is using more flexible approaches enables adaptation to health changes, market conditions, and economic circumstances. It's nice to have a flexible retirement. which is why study after study show that many retirees with flexible spending approaches report much higher satisfaction compared to those with fixed and high expenses, even during uncertain market conditions. So now that you understand all the strategies for staying retired, let's look at the complete implementation framework of how to put it all together. First, begin with realistic projections of retirement costs, including inflation at 3% and healthcare inflation at 6.5%. You can also bake in long-term care event if you want to be extra cautious. Next, plan out your withdrawal sequence as tax efficiently as possible and adapt your actual percentages each year based on prior market performance. You can build yourself those guardrails. Then coordinate your spending flexibility with essential expense protection to keep your core lifestyle needs during periods of higher inflation. Finally, you want to monitor and adjust these strategies based on actual live inflation, market, and economic conditions because, look, at the end of the day, personal finance is personal for a reason, and of course, your circumstances will change. This step is crucial to a plan that actually works in the real world and not just one that works on paper, in a spreadsheet, or in a software. And to better ensure your plan's success and keep you from having to return to work or take a big lifestyle cut, do these final steps. Rather than just setting and forgetting it, test out multiple projections, especially those that are aggressive, realistic, and conservative. You want to be prepared for higher costs rather than only assuming optimistic scenarios, and nothing's guaranteed. You much rather be safe than sorry, and it's good to test all equations. For example, if you have a rental property and that's going to be part of your retirement income, you want to assume that your rental home will be vacant at some point. You don't want to hope that the stock market just keeps doing 10% or more per year in the future to make up the difference. But on the other side of the coin, you don't want to be overly too conservative. Here's what I mean. You also want to make sure that your plan is actually realistic because I've seen too many people who were overly cautious. And for example, they have IRAs that grew into a much larger tax problem than they were anticipating, which again, it's a good problem to have until it isn't. And if you're trying to figure out how to put the retirement pieces together, you may want to consider professional guidance that actually provides options to ongoing adjustments along the way. Whether it's a one-off, one-time financial plan, of course, that could be valuable, but nothing really beats having someone in your corner who specializes in retirement planning and has seen hundreds of other retirements just like yours. Finally, you have to identify which lifestyle elements are most important to you and seriously guard those with everything you have because that's what it's all about. Sure, you can be flexible with all the other things, but always prioritize time and experiences with your loved ones, your grandkids, when you can. Because again, when we look our clients in the eyes and we talk about what's really happening in retirement and what's causing them the most joy, well, that's what it's all about. And that's what makes it all worth it. So now you understand how much you need to save to stay retired, whether you're retiring this year, in 5 years, or 10 years from now. And most importantly, the strategies that will enable you to have a sustainable retirement despite increasing cost. And hopefully after watching this, you can now build a retirement plan that lasts, not just one that gets you to the retirement starting line. And if you're ready to get professional guidance on optimizing your retirement strategy and building the retirement that you've always wanted, then click the link below to schedule a call, and I'd be happy to chat with you. Thanks for watching. I'm Kyle Kuyat, and I'll see you next time.